Oh, you saved us a couple minutes. Maybe just to add briefly, as was said, Alex and I spent all of our time traveling across the country, really educating plan sponsors on kind of how the pension market works, different solutions, and talking about all the changes that have occurred. And that's really the spirit of our presentation today. So in terms of an agenda, there's only 2 things listed. However, there's a lot of sub-bullets. But what we hope to cover today is talk about the current environment as it relates to pensions and other post-retirement benefits. So a lot of discussion is around the pension side. We do want to introduce a few dialogues around other post-retirement benefits. And then secondly, I want to talk about the solutions that are being explored for these benefits and how they're being implemented and some ways that you can begin to prepare. So please feel free to ask questions. We'll be monitoring along the way. And with that, why don't we go to the next slide. So maybe to start, I'll start with a 40,000-foot view and give a little background on sort of the risk transfer market. In about 2005 or 2006, we Prudential began to form a team to focus specifically on the pension market. We saw a lot of trends coming that led us to believe that plan sponsors would begin to de-risk their pension plan. Fast forward 11, 12 years from now, I think many people have seen all the activity in the pension space, and throughout all these dialogues we've had, we've really gotten to understand some of the priorities of the folks in the C-suite, not only as it relates to the pension plan, but as it relates to all sort of post-employment or retiree obligations. And the one thing we've begun to learn is that many of these tools that sponsors are interested on the pension side, they're also interested on the retiree medical and life insurance slide, which is why we sort of at the top of this page don't just have pension obligations, but have all the obligations that are on the balance sheet relative to retirees. I would say throughout the past 10 years, we've heard from CFOs and treasurers with a few goals in mind. Those goals being, they want to invest in their business, they want to grow their dividend, they want to generate a stable cash flow for their business, they want to exceed shareholder expectations, and they obviously want a very healthy balance sheet and good credit ratings. And so in many cases, many of these OPEB or pension obligations were working against some of those priorities. And so sponsors began to explore different ways to align their objectives, such as creating financial flexibility. They wanted to reduce leverage, maybe create a more stable cash flow, and so they've begun to look at various solutions. Really quick, I think you could see that all these benefit obligations have some common challenges and considerations. So, many of them contain longevity risk or medical inflation, legislative risk, could be asset risk, and then on the corporate governance side, many of these companies just want to focus on their core business. They want to stabilize their balance sheet. They want to improve their views of the rating agencies. And so we've really seen a shift around companies beginning to address all these obligations in a holistic view. So they're looking at different design programs. How do you change the design of the program so maybe it's not as cost effective? How do we fund this to stabilize volatility going forward? And then what we're here to talk about mostly today is how do you settle some of these obligations? So with that as sort of the backdrop, maybe I'll turn over to the pension landscape. Next slide. Okay. So this slide is quite busy. There's a lot on it, but I think it does a good job summarizing kind of what's been going on the past decade or two with regard to the pension world. Probably the first thing to notice, and I think every pension presentation starts with this, is the line that goes up and down that really reflects the average funded status of the top 100 pension plans, corporate pension plans in the U.S. And so you can see it's been quite volatile, and there's been a few situations where it's gone down quite a bit. So obviously, the 2002 timeframe with the tech crisis, sort of end of 2008 with the credit crisis. And the thing that continues to amaze me, if you look at the beginning of this chart, the average pension plan in 2000 was 135% funded. And as we sit here today, the average pension plan's 84.9% funded. So the average pension plan has actually lost in this 17-year time frame 50% funded status. And the thing that's really eye-opening to me is that there's like a little blue line below the chart there, and it says there's been $676 billion of contributions. And so right away you can see, the top 100 plans have lost 50% funded status, despite putting in, 2/3 of $1 trillion of contributions. So the first big thing, obviously, has been the volatility. Second thing I'll point out, and I'm not going to go through these, if you look along the top, there's a lot of acronyms and various regulatory actions. So you can see that the pension market's been highly active in terms of new regulations, funding relief, new mortality tables. So there's just been a lot going on for sponsors to monitor. If we go to the bottom, obviously the capital markets have gone, I guess, two separate ways. We're at an all-time high for the equity market, but most folks know interest rates are also at all-time lows, which obviously is driving much of the levels of the funded status. Another trend has been around mortality tables. Again, at the bottom here, you could see, every 10 years or so, mortality tables have changed, and the Society of Actuaries is going to be more regular in terms of updating mortality, but that certainly had the impact of increasing benefit obligations over time. And then maybe one that I'll hit for a minute and then turn it over to Alex to talk about how some of these trends have manifested itself in the pension risk transfer market, are the PBGC premiums, because these in and of itself have driven a lot of activity over the past few years. And maybe we'll go to the next slide. So PBGC, obviously Pension Benefit Guaranty Corp premiums. These are the premiums that plan sponsors have to pay to the government to cover the protection of the pension plans. And there's two components. The top line is a flat rate. So plan sponsors, if you look at sort of the 2006 to 2012 time frame, had paid $30, $35 per participant covered under the plan. And then you can see since then it's ramped up dramatically, fully phasing into north of $80 by 2019. The other component, which could be even more, depending on the makeup of your plan, even more penalizing, is the variable rate premium. So you can see the variable rate premium had been 0.9%, and then around 2003 scaling up, it'll be north of 4% in 2019. So a plan sponsor who has a significant amount of lives and a significant underfunding is going to be paying a pretty hefty per person rate, as well as 4% per underfunded dollar. Now those are capped per person, but nonetheless they've ramped up dramatically. And maybe as an example, and we won't go through all the details, you have these slides. The next page actually shows a illustrative plan, about $200 million with 2,000 participants, and you could see over time the total PBGC premium in the pink, kind of bolded there, has gone from $264,000 per year up to $1.258 million per year. So roughly a 477% increase just in the hard cost of the PBGC premiums, without even factoring all those other variables we talked about. So, and this has really led itself to many small balance transactions. So what I mean by that is a lot of companies who have significant numbers of retirees may have individuals that have people, retirees who are getting $100 per month, $200 per month. And so a lot of the activity we've seen in the market has been driven by these PBGC premiums and those small balance deals where the employer is trying to get rid of this $85 fixed head, maybe plus the variable component, to retirees who are only accruing $100 or $200 per month. So it's been very economical for plan sponsors to focus on some of these small balance transactions. So with that said, maybe I'll turn it over to Alex. So that sort of the PBGC premiums plus the volatility and everything else I talked about has sort of led to an emerging and maybe booming, I don't know quite the right word, market. But I'll turn it over to Alex to take it from here.
Yeah, so as Scott said, this has really been a focus of Prudential really since around 2005, 2006, but the industry in general has been around for a really long time and has been in business at Prudential for a very long time. We actually sold our first contract back in 1928 and are still paying out 2 participants on that contract. So these are in general very, very long duration contracts. But really prior to 2012, the industry has really been about, the total industry has really been about $1 billion or so a year, and most of that activity has been driven by plan termination. In 2012, the kind of monumental transactions of GM and Verizon occurred, and you can see those transactions here. GM was about $25 billion, Verizon about $7.5 billion. And those transactions kind of changed the market. Those transactions were not full plan terminations. They were transactions that just involved the retirees of a plan. So really since 2012, most of the activity that we have seen have been actually retiree transactions. And since 2012, putting the GM and Verizon transactions aside, you can see on this slide how the market has grown year over year, has kind of doubled essentially year over year, with last year being about flat from the year before. I think most people in the industry expected this year to end up around $18 billion or so, and it has been a very, very busy first half of the year, so I think we are on target to hit that. As Scott said previously, starting last year, we started to see a new trend where plan sponsors maybe didn't transact on all of their retirees and instead focused on a subset of their retirees, with that subset being really just a small balance participants. So the participants that would be the most efficient for the plan sponsor to transfer as far as reducing administrative costs as well as PBGC premiums. This slide just really highlights a number of transactions that have occurred over the last couple of years. Most of the transactions that make the headlines are the multi-billion-dollar transactions, so like the Kimberly-Clark, the GM, Verizon, that are multi-billions. However, most of the market is really less than $1 billion. Of that $14 billion in total activity that occurred last year, there were over 400 transactions, which essentially means that the average transaction that actually occurs is less than $50 million. So we just wanted to highlight a couple of transactions that have occurred over the last couple of years that they made public disclosures. One question we commonly get asked is, what would make a plan, what's kind of the perfect formula for a plan to transact? And that's kind of a difficult question to answer because we have really seen a wide variety of plans transact. So there really hasn't been just one industry. We have seen, and you can see on this slide, the second to the bottom line, it highlights the industry of each of these transactions. But these transactions have been occurring over various industries. These transactions have been occurring with plans that are fully funded or overfunded, as well as plans that are in the 80% funded range. And finally, I think that there was a misconception in the market that the plans that need to do these transactions are plans that are very pension heavy, like a GM, where the pension plan is kind of dictating the earnings, and that's really not the case either. And that item is highlighted on this slide as well. You can see a line item for the plan size to market cap, with some plans transacting where the pension plan is less than 10% of their company, and some transacting where they are certainly very pension heavy in the 70% or so range. So if a plan sponsor decided they want to de-risk their pension plan, there are a variety of different routes that they could take. So I like to think of it as almost a spectrum of if the plan sponsor wants to fully retain the risk versus if they want to completely transfer the risk. So if you see furthest on the left-hand side, I like to call that status quo. So essentially having about a 60-40% allocation and taking advantage of any funding relief. So essentially just making minimum contributions. The plan could decide to make changes to their plan as far as design. So back in the late 80s, early 90s, I think there were a number of pension plans that decided to go with a cash balance formula versus a traditional formula to de-risk in that way. Pension plans over the last couple of years have also closed their plan to new participants or frozen the benefits. If a plan sponsor wanted to take an asset approach, Liability-driven investing has become very popular. That is essentially matching assets and liabilities. Or a glide path approach, which essentially means that as a plan becomes better and better funded, they would move assets out of equities and into fixed income. But if a plan sponsor wanted to fully transfer the risk, there's really only 3 options available to them. One would be a lump sum. In recent years, we've seen a lot of plan sponsors offering terminated vested a lump sum. So that is really the only group of participants that you can offer a lump sum without terminating the plan. So how these transactions have been structured, or how these activities have been structured, is essentially the plan would offer participants a 60 to 90 day window where they could take a lump sum in lieu of an annuity stream. The take rate on these transactions is really only about 50%, so you would ultimately only be removing a small slice of the liability. Then there's the 2 insurance options. Sorry, jumped ahead a little bit, of a buy-in and a buyout. I won't spend too much time on a buy-in because these have not been overly popular in the U.S., but essentially with the buy-in, the assets as well as the liabilities would remain on the balance sheet of the plan sponsor. Meanwhile, they would essentially be guaranteeing the payments for those participants. So the plan sponsor would continue to make payments to the participants, and then they would essentially just have an insurance contract on their balance sheet. The one downside of a buy-in is that the plan sponsor would retain all of the administrative and PBGC costs associated with those participants, and for that reason, many plan sponsors in the U.S. decide not to go with a buy-in approach and instead go with a buyout. So with a buyout, that's a complete settlement of the plan liability. The plan sponsor is essentially wiping their hands completely clean of the participants that they transact on. The asset as well as the liability would be removed from their balance sheet, and the insurer would begin making payments directly to those participants. And because they are completely wiping their hands free, all costs associated with those participants would be removed. I'm going to keep going because we haven't gotten any questions so far. So this next slide, what it aims to do is show kind of the standard plan if it has been frozen for a while, or a typical plan if it has been frozen for a while. So what it shows is there's a pie chart and shows 50% of this plan being made up of retirees or participants in pay status, 20% as terminated vested participants, and 30% as active participants. And if you recall earlier, what I said was prior to 2012, most of the transactions that occurred were plan terminations. And I do think that one of the reasons why is because plan sponsors didn't understand that there were options available to the different segments of their population, and they thought the only option available to them was actually a full plan termination. But what participants have, or what plan sponsors have been doing over the last couple of years, is focusing on different strategies of de-risking based upon the participant group. So essentially for retirees, really the only option available to a plan sponsor would be to purchase a buyout or annuities from an insurance company. For the terminated vested, it's most efficient for a plan sponsor to remove that group of participants through lump sum, hence why there's been an enormous amount of activity in the terminated vested lump sum space over the last couple of years. For the active, it is also most efficient to remove those participants from the balance sheet through lump sums as well. However, you cannot offer an active employee a lump sum unless you're going through a plan termination process. If a plan sponsor decided that they did want to terminate their plan, we do see take rates of around 80% for the actives and term vested. So what this next slide aims to do is show the economic cost of holding on to a group of retirees. If a plan sponsor decided not to transact with an insurance company and hold on to that liability themselves, how much it would actually end up costing them over the lifetime of the plan. So if you start furthest to the left, there's a dark blue bar, and what that first dark blue bar represents is the gap retiree liability, or the liability that the plan sponsor is holding on their balance sheet with regards to the retirees. And in this case, it is $100 million. And what that gap retiree liability, what it represents is just the present value of all future benefit payments. There are numerous costs that that the plan sponsor will have to pay that do not go into that liability, and that's what these next light blue bars represent, are the different costs borne by the plan sponsors that aren't reflected in their retiree liability on their balance sheet. So that first one is the administrative and PBGC cost. I think we've talked enough about the PBGC expenses, and I do think that this chart is being a little conservative or generous with how little this plan is paying in PBGC costs. I think that bar is usually much larger, especially given the recent updates in PBGC premiums. The next bar represents investment management fees, and finally, credit defaults and downgrades. So if you add all those up, what we would say is the true economic cost of this plan is actually $107 million, or 107% of what you're actually holding on your balance sheet. If you move furthest to the right column, that represents how much it would cost to move these participants to an insurance company or to purchase a buyout. In this example, the cost is 104% of the gap retiree liability, or a 3% savings. One question we get asked a lot is how can it cost less for an insurance company to hold on to that liability versus a plan sponsor? And there's a number of reasons why. One is that as an insurance company, we are outside of the ERISA framework, so therefore we do not pay any sort of PBGC premiums. Two, just being the large insurance company that we are, we have scale. We pay out millions of participants, and therefore our administrative costs are less, as well as we have over $1 trillion in assets, and our investment management fees are probably less as well. And finally, just we have access to access to asset classes that you as a plan sponsor would not. So as Scott mentioned earlier, one common trend has been for plan sponsors to not transact on all of their retirees, and instead to transact on a portion of their retirees. And the reasoning behind this is because these are the most efficient for a plan sponsor to move to an insurance company. And this is what this slide really aims to show. So that those dark blue bars, what those represent is the economic cost if a plan sponsor was to hold on to that liability themselves. And as you move from the left to the right, the average annual or the annual benefit size is increasing. So for that first bar, it's showing that the plan sponsor would end up paying 126% of their PBO, or their gap retiree liability, if they were to hold on to these participants themselves. And a primary reason that number is so high is, once again, because of the administrative and PBGC costs associated with those participants. So if a plan did want to move forward with a transaction of some kind, there is a number of steps that they should take, or that they will take. The first would be to complete an assessment of their plan itself and to make decisions around how they want to de-risk their plan. So for example, should they complete a terminated vested lump sum window if they have not? Should they consider a buy-in versus a buyout? Should they consider a plan termination? Or should they consider a small balance retiree buyout? So really just analyzing all the different options available to them and then deciding to move forward. There's also a number of operational things that they would have to do, such as making sure that their data is clean. This is probably the #1 reason why transactions can be held up, is because the plan sponsor doesn't have clean enough data for them to actually transact with an insurance company. And to the extent that the transaction would occur, so there's two ways to pay for a transaction. Transactions can either be paid with in cash, and for a majority of the transactions less than 100 billion, or almost all the transactions less than $1 million, we see those paid in cash. But once the transaction gets larger than 100 million, you see some plan sponsors choosing to transfer assets, and assets with a combination of cash. So there might be some reallocating of assets in order to make a more optimal portfolio for an insurance company. And finally, the plan governance. So just another potential holdup would just be getting buy-in, essentially, or the approval to move forward with a transaction internally. So with that, that concludes everything that we wanted to talk about as far as the pension plan. I will turn it back over to Scott, who's going to cover retiree medical and life insurance.
Great, and we actually do have some questions on the pension side that we'll come back to in a minute. But I'll just talk about really quick the medical and life side. So on the slide that's on the screen, again, using kind of the similar framework of design, funding, and settlement, I think a lot of the same concepts apply. There's certainly differences in the medical coverage. I mean, it's regulated differently. Doesn't have to be funded. You can actually take away the benefit. So while there are certainly differences in how this is regulated and financed, we think the framework is very similar. So on the design side, whereas in the pension side, you've seen companies freeze benefits, stop it for new entrants, do various design elements. The same thing has happened on the medical side, whether it's capping the employer contribution or introducing some sort of cost sharing to the retirees, changing eligibility requirements or age or service standards. A lot has sort of happened on the design side. Relative to funding, without getting into a lot of details again, there's certainly opportunities to finance these and fund these, whether it's through VBAs. You can contribute to health reimbursement accounts. You can introduce, as part of both the design and the funding, you can introduce exchanges for the retirees. So there's a lot of innovation going on there. And then consistent with settlement, there's also options similar to buyout or buy-in, where you can take some of these potentially redesigned benefits where you've locked in or created more of a fixed payment stream, and you could basically annuitize that as well. So the life insurance company like Pru witnesses our take on medical insurance. But if you think about, maybe you're making a $3,000 fixed payment to a retiree to purchase health insurance on an exchange, that $3,000 payment essentially is an annuity. It just has to be used to purchase health insurance. And so we see sponsors beginning to get interested in looking to settle some of those medical obligations, because they're quite large, and like I said, they do have some different rules. But those companies who are trying to tackle all these benefit obligations are finding that it's a very good time to look at these as well. On the life side, I won't get into a lot of details here, but the life side is very similar. You have a retiree life insurance benefit, and quite simply, you could just transfer the risk of that to an insurance carrier. These actually have happened quite a bit. Maybe quite a bit overstating it, but they have happened a decent amount over the past several years. I mean, they are much smaller than the pension liability, but here you can essentially transfer the mortality and investment risk of the life insurance that you've offered your retirees while honoring the promise to them. So certainly happy to answer some questions there, but I just wanted to begin to introduce that overall framework of looking at both pension and OPEB liabilities. So with that said, I do have a few questions coming through. First one, maybe I'll ask Alex. The first one is around targets. You talked about, early on, you talked about the slide that showed targets in terms of characteristics. Can you just talk about, like, I know you said there's not one size fits all, but can you just talk a little bit more about what's a common characteristic, whether it's funded status or fixed income? Let's talk through some of those things that companies look at.
Yep. Let me go back to that slide. I think I know which slide you are referring to. This slide?
Yeah. Like what makes a good, I know there's not one size fits all, but what makes a good characteristic for a company to consider this?
Yep. I mean, I would say in general, the better funding a plan is, the better. That just makes the transaction more affordable and less of a cash contribution that could potentially be necessary. I guess I will caveat that with when a retiree buyout occurs, the plan sponsor is not obligated to restore the funded status. So naturally, with a transaction, if the plan is not fully funded, that the funded status of the plan will deteriorate somewhat after the transaction. So the plan sponsor is not obligated in any way to restore that funded status to where it was previous to the transaction, but in practice, most plan sponsors actually do. But I would say one would be the better funded the plan, the better. Two, I would say that if the pension plan is very large in relation to the size of the company, I mean, certainly there are the companies where the pension plan is tiny and they just want to get rid of it because it's just a headache. But also if the pension plan is very large in relation to the company, that they want to no longer be making decisions on their company based upon the pension plan and just want to concentrate on making widgets or whatever they do. And finally, I would say if a plan sponsor has shown any interest in other de-risking activities, so if they have already closed their plan or frozen it, or maybe haven't offered a terminated vested lump sum window, or any other sort of de-risking activity, that's probably a good indicator if that they would move forward with the transaction.
I think a couple, I'll just add to that, a couple, I think, qualitative ones that we see a little bit is, when you get changes at a company, whether it's a new CFO or treasurer, that could be an impetus for relooking at the pension plan. We certainly see, some sort of corporate event, so whether it's an M&A or a spin-off, that at times can lend itself to kind of cleaning up the balance sheet and the pension plan. We also see, I think that's the majority of the qualitative ones. Yeah. Here's another question. Alex, you're talking about process. Can you talk a little bit about how long it takes to execute a pension risk transfer, whether it's just the actual process or maybe some of the lead work that goes into it?
Yeah, so if a plan sponsor does let's say that they get the approval internally that they want to move forward with the transaction, from beginning to end, I would say that a retiree-only transaction, so an important distinction there, a retiree-only transaction can be done in about 90 to 120 days. Of course, as I mentioned earlier, the data being a big part of that would be reliant on the fact that the data is in good order. But a retiree transaction, there's no regulatory approvals that are required whatsoever. There's really no red tape. I have seen transactions occur as little as a month or less, but that's probably not ideal. I'd say the standard transaction is probably more in the 3 to 4 month range. If a plan wanted to fully terminate, then the process the timeline of the process definitely lengthens a bit. Average termination is probably close to a year or 15 months. There are regulatory approvals that are required. They have to file with the PBGC, and they could choose to, they have to file with the PBGC, and then they could choose to file with the IRS or not. But those approvals take time, and that just lengthens the process.
Can you maybe just quickly hit the 95-1 process as part of that? Like, explain, that wasn't a question, but I know people have that a lot. Like, what does that mean?
Yep, and then I'll have you answer the next question since you're handing them all over to me. So the 95-1 process, if you're not familiar with that, that is a Department of Labor bulletin which essentially mandates that as a plan sponsor, as a fiduciary, there are steps you have to take to ensure that if you are to transfer this liability to an insurance company, that your participants are safe and that they will continue to receive their benefits. So in doing that, they have to send out quotes to various insurance companies and really find what is deemed to be the safest available annuity provider. There are a number of things that go into that. There's essentially some criteria that go into that, but it means anything from making sure that they have administrative capabilities that they can support bringing on these participants, or credit rating, or just making sure that the company is financially stable enough to support the payment. Does that answer your question? So looks like there's another question in here. Someone is asking on, in the U.S., are there any longevity-only transactions that have occurred? They have heard that those transactions are occurring overseas and want to know if there's a market for them in the U.S.
Yep. So earlier, Alex, one of the slides talked about buyouts, buy-ins. A third variable, to Alex's point, has occurred internationally. It's been longevity-only transactions, and so if you think about the risks in a pension plan, you can largely put them into two major buckets. You have capital markets risks, and that could be interest rates, credit defaults, equity markets, and then you have longevity, like insurance risk. And so some of the plans in the UK have actually transacted longevity only, and there's been a bunch of reasons for that. One of them being that longevity is a little different over there in that many of the benefit structures internationally have cost of living adjustments, whereas in the U.S. they don't. Most of the benefits are fixed. And so I guess the quick answer is we have not yet seen a tremendous amount of interest for longevity-only products. And really simply, the way those would work, for anyone familiar with an interest rate swap, and I don't want to get too technical, but you would basically lock in your mortality basis, and then you would just exchange kind of fixed for floating, so whatever happened. But essentially, you're locking in your mortality today for a fee. I mean, the benefit is you don't have to pay a huge single premium like a normal buyout. But again, most CFOs in the U.S. Have longevity risk pretty far down on the worry spectrum. And sort of my only bad joke of the day is, longevity risk can't kill you tomorrow. I mean, CFOs are usually trying to figure out what's going to hurt their company tomorrow. I mean, if people live forever, that's kind of a slow risk that emerges over time. And so they just haven't focused on it. We might see it at the very large end of the market, jumbo plan, who has a really good LVI program and is comfortable with that type of risk. But to date, we have not seen it.
Looks like one more question here. Why aren't plan sponsors, or what is prohibiting plan sponsors from moving forward with the transaction?
A transaction, or maybe just even consider, I guess maybe it's more considering one.
Yeah, just considering one.
I mean, I think there's probably a lot of reasons. Quite honestly, one of the primary ones which we've tried to help alleviate over the years is just lack of education. So, I mean, I think it's a lot better today, but, go back 5, 6, 7 years, I think the average plan sponsor thought it costed, 130% to get out of a retiree obligation, or that it took 6 months, or not 6 months, 3, 4, 5 years to get out. So I think the more and more that individuals have been educated, it certainly helped. I certainly think, companies are busy, investing in their firms, doing M&As, things like that. And maybe they just don't. It's not that big of a risk that they care about. So a couple of those examples, like on the slide still, had the pension plan pretty small relative to the size of the company. So on one hand, maybe they don't get a lot of questions. And don't get pressed from rating agencies and shareholders. The flip side of that is, since it is pretty small, you can get out of it relatively easy with not a lot of cash. So we've really seen a bunch of different reasons why companies have not moved forward. Another one is they are moving forward. It's just they're part of a glide path. Maybe they want the funding gap to close. They don't want to put cash in today, so they're waiting for interest rates to move. I guess our reaction to that could be, you don't have to do the whole thing right now, but maybe look at a smaller population and use your fixed income to transact. Maybe that company on the glide path is also doing lump sum programs, just different activities. So there's a whole host of reasons why companies haven't moved forward yet, but I think the key point being many are, and we've seen the market grow from $1 billion. Obviously it spiked to $35 billion in 1 year, but we've seen a very nice trajectory, over the past 5 years, and continue to see it. I mean, activity continues to be very, very high, and we see it in the foreseeable future. Maybe one other question I'll ask myself. Can I do that? Ask myself a question. I think along this topic, one question we get a lot is around capacity, and I think the spirit of the question is probably more around, if all these pension plans came to the market, are there going to be capacity constraints? Are the insurance companies, not going to have the financial resources to do transactions? I guess my answer to that would be we're still a pretty long ways away, I think, from that happening. I mean, a $14, $15 billion market. I don't know the exact count, but there's probably 13, 14, 15 insurance carriers. They all have different appetites, but 13 to 15 insurance carriers participating in this market. So there's plenty of room to run in terms of deal sizes. To me, the bigger issue is, one, it all can't happen at the same time, right? So even if the market tripled or doubled, you could probably get a lot of it throughout the year. But if it all happened in 1 month, that'd be an issue. And then the bigger issue we see is around resource capacity. So just the internal teams to price this stuff, the legal resources, the advisors, the asset folks in the market help them to do an AIK transfer. So to me, the bigger issue is around the people capacity as opposed to financial capacity, because I think insurance companies will continue to invest here.
Thank you so much, Scott and Alex. We did have one more question sneak in about how to go about getting rid of the retiree life liability. Is it a straight buyout?
Yeah, it's a straight buyout. There's a set of data that the carrier would need, not too dissimilar to the pension plan, but it is a straight buyout where it gets off your balance sheet.
Okay, thank you so much. We actually just had another request that just came in to pull up the slide with retiree medical settlement info. Someone would like us to pull that slide up. I'll let you choose where it goes.
Yep, I think I have it up.
Okay. Hopefully if they're getting what they need off that slide, or if there's another question regarding this information, they'll send it in. Yep, we will be sending this slide deck out after the webinar tomorrow with all the HRCI and SHRM credit information. I did see another question sneak in, and this is pretty specific maybe, about what a plan sponsor should do in advance or preparation for getting their data ready so that it's not a holdup. Is there best practices or the service or anything you can recommend or offer?
Yeah, I mean, so I would say in general, for a retiree transaction in general, the data does seem to be pretty clean, and the reason for that is because you are paying these participants currently. So hopefully you have the right payment information. Otherwise, I'm sure that they'd be calling and letting you know. Versus like if you have completed a terminated vested lump sum window, the data in those instances seems to be a lot more messy because those participants are no longer employed by the company and they have not yet commenced payment. So in general, I would say the retiree data is pretty clean. You can certainly work with your actuary to clean up the data. Otherwise, there are a number of firms that specialize in data cleanup.
Okay, wonderful. Well, thank you again for all this information that you've provided, and certainly we'll send the slides and credit information out tomorrow. And attendees, thank you so much for joining us, and feel free to reach out to Scott and Alex. Thank you both for providing such great information for our attendees today. We certainly appreciate it.
Thank you.
Thank you.
All right. Have a great afternoon. Bye-bye.